So picture this. It's June of 2026, and Summit Hotel Properties just managed to boost profits on two of their Arlington, Texas hotels by nearly 85% in a single month.
Right, a massive spike.
Yeah, exactly. And their very next move, they sold them.
Just completely offloaded them.
Right. So today, welcome to another Talk Tickers deep dive. We are tearing into the Q2 earnings transcript for ticker INN.
And we really need to figure out why offloading your most lucrative, highest performing assets right at their absolute peak is, well, actually a masterclass in Wall Street execution.
Yeah, I mean, we're looking past the lobby aesthetics today. We are digging straight into the capital allocation strategy of a management team that is actively reshaping their balance sheet in a notoriously tricky macroeconomic environment.
Right. You know, the Arlington sale is really the perfect entry point for this deep dive.
Oh, absolutely.
Because it completely shatters the assumption that real estate investing is simply about, buying assets and holding them forever just to collect rent.
Yeah, the classic buy and hold myth.
Exactly. What we are seeing in this transcript is a management team operating with a highly active, almost surgical approach to capital recycling.
They aren't just operators, right? They are asset traders at this point.
That's the perfect way to put it. And understanding the timing of that trade requires looking at the broader demand shocks in the quarter.
Right. And that demand shock has a very specific name.
Oh, yeah, it does.
It's the FIFA World Cup.
Yeah.
So let's look at the overarching top-line metrics first, just to contextualize this for you.
Good idea.
Pro forma RevPAR, which is revenue per available room, for the entire portfolio grew 5% in the second quarter.
Right. A solid baseline.
Yeah. And adjusted EBITDA rose 7.7% to $54.8 million.
Which is a very healthy jump.
And then you have adjusted FFO, which increased 6.7% to $34.9 million total. That's 29 cents per share.
Right. And for anyone new to REITs, real estate investment trusts, FFO, and EBITDA are really the true measures of cash flow and profitability.
Because they strip out all the messy depreciation stuff.
Exactly, yeah. But embedded in that 5% RevPAR growth is this massive World Cup footprint.
Oh, it's huge. Because Summit operates heavily in host markets like, Atlanta, Dallas, and San Francisco.
Right. And they saw June RevPAR in those specific markets spike over 20%.
Over 20%. So, I mean, the immediate skeptical take here is this, right?
Let's hear it.
Management just got bailed out by a once-in-a-generation sporting event. They captured the sugar high, and the underlying 5% growth figure is actually artificially inflated.
It's a fair concern. But you have to parse the data further to really test that thesis.
Right.
And management actually anticipated that exact critique, and they quantified the FIFA impact.
They did. They estimated the World Cup added approximately 100 basis points to the total RevPAR growth for the quarter.
So if you isolate the portfolio and strip out those 6 host markets entirely, the non-FIFA markets still delivered 4.2% RevPAR growth.
Which is, a 4.2% underlying growth rate in a macro environment where, consumer discretionary spending is heavily scrutinized.
It's incredible.
It's a massive indicator of structural rather than just event-driven demand.
I completely agree.
But I'd argue the 4.2% non-FIFA growth is actually less interesting than how they achieved it.
Oh, definitely. The mechanics behind it are fascinating.
Right, because it was almost entirely driven by the average daily rate, or ADR.
Yeah, they pushed pricing hard.
ADR jumped a massive 7.1%. And look, I see a 7.1% rate hike year over year, and I immediately worry about demand elasticity.
Sure, the substitution effect.
Exactly. At a certain point, a 7.1% hike triggers people to pull back. It's like a coffee shop suddenly charging $5.50 instead of $5 for a latte.
Right. Eventually, people stop buying the latte.
Yeah. The corporate travel manager flags the expense, or the transient traveler trades down to a lower tier hotel, or the family shortens their weekend trip by a day.
It's a very real risk.
So are they pushing pricing power so aggressively that they are quietly destroying their own occupancy baseline?
Well, that is the perpetual tightrope of yield management, right?
Right.
But the financial payoff for successfully walking that tightrope is just enormous. Which brings us to, honestly, the most critical metric in this entire transcript.
Just hear it.
90 basis points of margin expansion.
Oh, wow.
Yeah. Summit achieved a 54% flow-through on incremental revenue this quarter.
54%.
Right, and that answers your question about demand destruction.
How so?
Because when you rely on occupancy to drive revenue, meaning just putting more bodies in beds, your variable costs scale linearly.
Right. More guests mean more towels to wash.
Exactly. You scale up housekeeping, utilities, and perishable amenities. And so your margin degrades.
I see.
So when revenue is purely rate driven, like we're seeing here, the cost to turn over that room remains completely static.
Oh, that makes total sense. Whether the guest pays $180 or $250, the marginal cost of servicing the room is identical.
Exactly. The flow through to the bottom line is just explosive.
Right. But, I mean, that assumes the operating environment is static, which we know it totally isn't.
Fair point, yeah.
Because if you are charging a 7.1% premium on the room, the guest expectation inherently rises, right?
True. They want a better experience for that price.
Which typically pressures management to increase operating spend to justify the rate. Plus, inflation doesn't just hit the top line.
No, it definitely hits the expenses too.
Exactly. Let's look at the expense side of the ledger. Total operating expenses rose 4%.
Right.
So the 54% flow through is impressive, definitely, but they are still fighting margin erosion on the back end.
They are, but they are actually winning the fight through labor optimization.
Okay, tell me more about that.
Well, total labor costs were up 4.3%, which, pretty much aligns with the broader wage growth data we've seen across the whole service sector.
Yeah, that's not surprising.
Right. But the real nuance here is in the composition of that labor. Contract labor actually declined 4% year over year.
Oh, wow. Now that is a crucial detail.
It's massive.
Yeah, for anyone tracking hospitality REITs, contract labor is the ultimate margin killer.
Oh, absolutely. It destroys profitability.
Because when you have to staff a front desk or a housekeeping shift through a third-party agency because of internal turnover, you are paying a massive premium.
Right. Often 30 to 50% above your normal internal hourly rates.
Just to cover the agency's margin.
Precisely. So a 4% reduction in contract labor signifies that their internal retention and recruitment funnels have finally stabilized post-pandemic.
They've normalized their staffing models.
Exactly. And CEO John Stanner specifically noted that turnover is well below what they experienced in prior years.
Which is a huge relief for them, I'm sure.
Right. And that stabilization allows them to project flat hotel EBITDA margins for the full year, which I know sounds unimpressive at first.
Flat margins never sound great on the surface.
Right, until you factor in the external headwinds they're absorbing right now.
Oh, right, the 25 basis point hit from property taxes.
Yes, exactly.
Yeah, municipalities across the country have been reassessing commercial real estate values based on the inflationary spikes of the past few years.
Right, everyone's property values went up on paper.
And that lag effect means REITs are getting hit with significantly higher tax bills now.
Which is tough, because property taxes are a fixed, uncontrollable expense.
You can't negotiate with the tax assessor, usually.
Exactly. But Summit is entirely offsetting a 0.25% margin drag from property taxes through their ADR strategy and this internal labor optimization.
So they are effectively outrunning local tax assessors by aggressively pushing room rates.
That's exactly what they're doing.
It's an impressive operational feat, honestly, but it forces us to look closely at who exactly is paying these higher rates.
Right. Who is absorbing this 7.1% hike?
Yeah, because to maintain that kind of increase, you need an influx of pretty price-insensitive buyers.
You do. And the transcript paints a very clear picture of where that demand is originating.
The urban footprint, right.
Exactly. The urban portfolio saw RevPAR jump 8%, with Hotel EBITDA climbing 12%.
Which represents a massive inflection point.
Oh, no, huge.
Because for the last 3 years, the narrative has been totally dominated by the Sunbelt resort boom and, the death of the urban core.
Right. Everyone thought downtown hotels were finished.
Yeah. And Summit's portfolio is roughly 50% urban. So the fact that urban ADR rose 9% indicates that the primary engine of their portfolio has fully restarted.
And we know exactly which segments are driving that urban engine too.
Right. Corporate negotiated RevPAR grew 7.5%.
Yep.
And group RevPAR saw staggering growth of 15%.
15% is incredible.
But the metric that really stands out to me is midweek performance.
Oh yeah, the midweek numbers are fascinating.
Because if you isolate just the midweek days in their urban locations, retail, negotiated, and group RevPAR all jumped by more than 15%.
Wow.
And that isn't a family taking a long weekend. That midweek compression is the absolute hallmark of the corporate traveler on an expense account.
Exactly. And, the corporate traveler is really the baseline layer that allows a hotel to aggressively yield manage the rest of its inventory.
Right. Explain how that works for our listeners.
Sure. So when a corporate event planner books a block of rooms, say 45 days in advance for an industry conference, they base load the hotel.
They guarantee a certain level of occupancy early on.
Exactly. So if the property is already 60% booked a month out, the revenue manager has the algorithmic confidence to dramatically hike the rate on the remaining 40% of the rooms.
For the transient traveler who books last minute.
Exactly.
Okay, let's drill into the transient traveler then, specifically the transient government segment.
Okay.
Because this has been a persistent drag for hospitality REITs, government travel operates on strict, non-negotiable per diem rates.
Right. You can't dynamically price a federal employee.
No, you can't. And Summit reported that transient government revenue finally increased 8.3% year over year.
Which is good to see recovering.
It is, but I have to question how valuable that revenue really is in a high inflation environment.
That's a fair question.
Because if ADR is up 7.1% across the board, but government per diems are notoriously slow to adjust upward, isn't taking government volume actually dilutive to their overall margins?
Well, in a vacuum, yes. Government per diems definitely represent a lower absolute margin compared to a premium retail booking.
Right.
However, government travel provides something just as valuable to a REIT, which is non-correlated, highly stable volume.
Ah, so it's a stabilizing force.
Exactly. It acts as an occupancy floor during off-peak periods or shoulder seasons.
That makes sense.
Yeah, and Standard described it as a gradual recovery following a period of meaningful drag. So they aren't relying on government travel to drive the 90 basis points of margin expansion.
They are utilizing it to absorb fixed overhead.
Exactly, which then allows the high margin corporate and group segments to fall directly to the bottom line.
Which is a smart play. But that assumes they're carefully modulating their channel mix, which brings us to, honestly, the most aggressive strategic maneuver detailed in the transcript.
The OTA decision.
Yes. Management made a deliberate, intentional decision to shrink their OTA channel mix. They actively rejected volume from online travel agencies like Expedia and Booking.com.
It's a bold move.
I really want to spend some time on this because walking away from the OTA duopoly is incredibly risky.
Oh, it's basically the equivalent of a consumer brand pulling their product out of Amazon to focus strictly on their own website.
Exactly. You are sacrificing guaranteed massive top-of-funnel visibility in exchange for margin preservation.
Right.
And I look at hotel inventory the same way I look at airline seats. An empty hotel room at midnight is an expiring asset.
Once the night passes, that revenue opportunity is just permanently destroyed.
Right. And the OTAs know this, which is why they command exorbitant commissions, often 15 to 30% of the booking.
It's a huge cut.
But they provide the safety net of last-minute volume. So by intentionally suppressing OTA availability, Summit is operating without that safety net.
They are.
They're gambling that their direct booking channels and corporate contracts can absorb the displaced volume before the inventory expires.
Right. But the data suggests it wasn't a gamble. It was a highly calibrated algorithmic shift.
Tell me more about that.
Well, they didn't just shut off the OTA tap blindly. They saw the forward-looking strength in the corporate negotiated and group segments.
The early bookings we talked about.
Right. And they made the mathematical decision that paying a 20% commission to Expedia for a transient guest was just a suboptimal use of the room.
They traded low margin, high commission volume for high margin, low acquisition cost volume.
Exactly.
But you only make that trade if you have absolute ironclad visibility into your future demand curve.
Yes, you have to be very confident in your forecasts.
And the entire thesis of this stock right now hinges on whether this pricing power and channel strategy is sustainable.
Which management clearly believes it is.
Right, because they raised full-year RevPAR guidance to a range of 1.75% to 3.25%.
A very bullish signal.
And they bumped adjusted FFO guidance up to 79 cents to 85 cents per share.
Right.
So when a management team raises guidance in a macro environment full of mixed signals, they are putting their credibility on the line.
They absolutely are.
So what metric gives them the confidence to publicly model that kind of forward strength?
It's a booking window.
Okay, break that down.
It is the ultimate lie detector for hospitality demand.
How so?
Well, during periods of economic anxiety, the booking window collapses. Consumers and corporations delay capital commitments until the absolute last minute.
Right. They want to hold on to their cash as long as possible.
Exactly. And that results in a surge of in the week for the week bookings.
Which has to be a nightmare for planning.
It is. That lack of visibility terrifies revenue managers, and it essentially forces them to slash rates to guarantee occupancy.
But Summit is seeing the exact opposite phenomenon right now.
Yes.
Bookings made 30-plus days out increased 6% year over year, and a massive 18% compared to the first quarter.
Which is huge.
And furthermore, bookings made 15-plus days out increased over 300 basis points from Q1.
Yeah.
Meanwhile, those panic-driven short-term bookings actually dropped 3% year over year.
Right. And Stanner explicitly noted this lengthening of the booking window was persistent across their non-FIFA markets as well.
So it wasn't just World Cup fans planning ahead.
No, exactly.
Yeah.
This is the structural foundation that supports the raised guidance. When corporate planners are willing to lock in capital commitments 30 to 45 days in advance at elevated rates, it signals deep confidence in their own corporate travel budgets.
Which is a great macro indicator for the broader economy, too.
Definitely. And that early base loading is what allows Summit to confidently reject the OTA volume we just discussed. The entire strategy is completely interlocked.
It's interlocked on the operations side, absolutely. But, operations only matter if the underlying physical assets are positioned correctly.
Oh, for sure. Real estate is still physical dirt and buildings at the end of the day.
Right. So let's pivot from the income statement to the balance sheet, because the capital allocation strategy here is arguably more aggressive than the revenue management.
I'd agree with that.
Let's go back to the hook. The sale of the courtyard and residence in Dallas Arlington South for $19 million.
Right. This transaction is a complete masterclass in the timing of asset recycling.
See, I look at a combined 45% RevPAR jump and an 85% EBITDA spike for those two specific properties in the month of June.
Driven by the World Cup, of course.
Right. And my instinct is, why on earth would you sell a cash cow right as it demonstrates that kind of explosive operational leverage?
Because you are recognizing the difference between a structural shift and a transient anomaly.
Okay, expand on that.
Well, management knew those assets were fundamentally misaligned with their long-term portfolio goals.
Right. They are older suburban properties.
Exactly. But they also knew that Arlington was sitting squarely in the path of the FIFA demand shock.
So they waited.
Yeah, Stanner actually stated they strategically retained ownership through the FIFA demand window.
Wow. They held the assets just long enough to extract a massive non-recurring dividend from the World Cup.
Exactly. Which inflates the trailing 12-month net operating income.
Right. They plumped up the books.
Yes. And then they immediately dumped them. They sold at a 5.4% capitalization rate based on the NOI prior to the FIFA bump.
And selling older suburban assets at a 5.4% cap rate in a stabilized interest rate environment is highly accretive.
Very much so. But, the sale price and the cap rate are only half the equation here.
Oh, really? What's the other half?
The real genius of this transaction lies in the capital expenditures they successfully avoided.
Deferred maintenance.
Exactly. By executing the sale when they did, Summit eliminated $7.6 million in near-term capital requirements.
Well, that is just, this is the hidden trap of real estate investing that retail investors often miss entirely.
Right. They just look at the yield.
Yeah, but physical assets decay. A hotel requires continuous, massive capital injection just to maintain its current tier.
Yep. You need new roofs, HVAC overhauls, lobby modernizations, room refreshes. It never ends.
Right. And $7.6 million in deferred maintenance on a $19 million asset is a massive liability.
That's huge.
So they didn't just sell an asset, they successfully transferred a $7.6 million liability to the new buyer.
Exactly. And this isn't an isolated tactical maneuver either. It is a core philosophy for them.
Really?
Yeah. Since 2023, Summit has offloaded 15 hotels for nearly $220 million at a blended cap rate of less than 5%.
That's a lot of churn.
It is.
Right.
And over the course of that disposition strategy, they have purged nearly $70 million of required capital expenditures from their balance sheet.
Wow. $70 million that they didn't have to spend out of pocket.
Right. They are systematically amputating the bottom tier of their portfolio, the older, capital-intensive, lower-yielding properties.
So the obvious question for you listening is, Where is that $220 million going?
Good question.
Because if you are constantly shrinking your physical footprint, you are shrinking your gross revenue capability. You have to redeploy that capital into higher yielding assets to justify the dilution, right?
You absolutely do. And we actually have a perfect case study of that redeployment in the transcript.
The Oceanside Fort Lauderdale Resort.
Exactly. They executed what they call a transformational renovation on this property.
And the ROI on this project is just staggering.
It really is.
Because post-renovation, total revenue for the resort jumped 31% compared to the same quarter last year.
31% is massive for a property that size.
And the Hotel EBITDA skyrocketed 80%.
Which perfectly illustrates the power of targeted CapEx when applied to the right asset, as opposed to throwing money into the Arlington properties just to maintain the status quo.
Right. It's night and day.
Exactly. By deploying capital into a high barrier to entry market like Fort Lauderdale, completely revamping the amenity base and repositioning the asset into a higher luxury tier, they unlocked an entirely new ADR ceiling.
And an 80% jump in EBITDA on a 31% revenue increase absolutely proves the flow-through mechanics we discussed earlier.
Right. It's the exact same math.
The fixed costs remain stable while the premium rate drops straight to the bottom line.
It's the classic yield management playbook applied to the physical asset itself.
They are trading high-maintenance, low-yield suburban boxes for high-margin, premium-rated coastal resorts.
Exactly.
But, executing this level of asset turnover requires an incredibly stable capital structure.
Oh, absolutely.
If your debt maturities are looming or your borrowing costs are spiraling, you totally lose the flexibility to execute these long-term repositioning plays.
Right, because you were forced to sell assets at a discount just to meet your liquidity needs.
Which is the REIT death spiral.
Exactly. Which is why the debt refinancing executed in June is perhaps the most critical long-term signal in this entire earnings call.
Let's talk about that. They secured a new $650 million senior unsecured facility, pushing the maturity date out 5 years to June 2031.
Right.
And let's contextualize the macro environment here. We are sitting in 2026. The era of zero interest rate policy is long gone.
It's history.
The cost of capital is elevated, and credit spreads for commercial real estate are heavily scrutinized by lenders.
Banks are not just handing out cash right now.
No, they aren't. So in that environment, securing $650 million of unsecured debt is a major vote of confidence from the credit markets.
It is.
But the truly shocking part is that they actually lowered their borrowing costs by 20 basis points at their current leverage point.
Which is a massive structural advantage.
How did they manage that?
Well, lenders look at the margin expansion and the asset quality improvements we've been talking about, and they price the risk accordingly. By locking in cheaper capital for 5 years, Summit insulates their balance sheet from any potential rate volatility if, the Fed is forced into a defensive posture.
That makes total sense.
And when you look at their overall debt profile, over 60% of their prorated debt is fixed rate, and that's including preferred stock.
And here is the ultimate bulletproof metric for me. They have zero debt maturities until 2028.
None.
For a REIT, debt maturity schedules dictate strategy.
Completely.
If you have a massive balloon payment due in 6 months, every operational decision is subservient to generating the cash to clear that hurdle.
Right. You can't renovate a resort if you need cash to pay the bank next month.
Exactly. So by clearing the runway until 2028, management has bought themselves 2 years of absolute operational freedom.
Which is huge.
They can focus entirely on yield management, CapEx deployment, and shareholder returns without constantly looking over their shoulder at the credit markets.
And they have engineered a very clever structural hedge to further protect their corporate cash flow, too.
Oh, you mean the joint ventures?
Yes. The transcript highlights their joint ventures with GIC, the Sovereign Wealth Fund of Singapore. Summit collects pro rata fee income for managing these joint ventures.
I really love this detail. It's an incredibly efficient use of intellectual capital.
It really is.
Summit uses its operational expertise to manage outside capital, and the fees they collect cover approximately 15% of their total annual corporate G&A expense.
Right. They are essentially subsidizing their own corporate overhead with sovereign wealth money.
Which further protects the dividend and the FFO payout ratio.
Exactly.
Which brings us to the ultimate question for you, the investor listening to this deep dive.
Right. What does it all mean?
Yeah. We have dissected the top-line ADR growth, the 54% flow-through, the intentional rejection of OTA volume, the massive urban and group recovery, and a capital recycling strategy that is aggressively purging liabilities from the balance sheet.
It's a lot of data.
It is. So what is the actionable takeaway for someone evaluating INN?
Well, you have to look at the alignment of capital returns. First, the stock offers an annualized dividend yield of approximately 4.6%.
Which equates to a quarterly payout of 8 cents per share.
Right. But, a high yield in real estate can sometimes be a trap.
Oh, definitely. A yield trap.
Exactly. It could be a sign of a distressed asset paying out more than it earns. But Stanner specifically emphasized that this represents a modest payout ratio relative to trailing 12-month AFFO.
Meaning the dividend is highly secure. They are funding the 4.6% yield easily out of free cash flow, with plenty of room to cover internal capex and debt service. But, the dividend is passive. I'm much more interested in their active deployment of capital in the equity markets.
The share buybacks.
Yes. They bought back 49,000 shares in Q2 at an average price of $4.27.
And if you zoom out on that program, since inception, they have repurchased 5.1 million shares.
Wow.
Which represents over 4% of their total shares outstanding, deploying $21.6 million.
I actually have to challenge this slightly, though.
Okay, let's hear it.
When a company is operating in a capital-intensive industry, like hospitality real estate, taking $21.6 million of liquidity and using it to buy back stock instead of paying down debt or acquiring new assets is a very specific, aggressive choice.
It is.
It tells the market that management's internal financial models calculate their own equity as deeply mispriced.
Oh, absolutely.
They believe buying INN at $4.27 generates a higher internal rate of return than investing in a new hotel or retiring more debt.
It is the ultimate expression of conviction in their own asset recycling strategy.
Right.
They have successfully sold off the bottom tier of their portfolio at sub 5% cap rates, lowered their borrowing costs, and dramatically improved the margin profile of the remaining assets.
So by buying back stock, they are concentrating the ownership of that improved higher margin portfolio among fewer outstanding shares.
Which should theoretically act as a massive tailwind for FFO per share growth over the next 24 months.
So synthesizing all these moving parts, the thesis for holding or acquiring Summit hotel properties is highly compelling.
It really is.
You are getting paid a secure 4.6% yield to wait. You have a management team operating a fortress balance sheet with no maturities until 2028.
Right.
They have successfully transitioned away from high commission discount channels to capture the premium corporate and group traveler.
Yep.
And they're proving they can absorb external shocks like property tax hikes through pure pricing power and labor optimization.
The overarching narrative here is really a shift in quality.
Definitely.
They have upgraded their physical assets through targeted capex and strategic dispositions, and they have simultaneously upgraded their revenue mix by leaning into the corporate and urban recovery.
Which is a powerful combination.
Right. And the resulting operational leverage is just beginning to manifest in that 90 basis points of margin expansion we talked about.
Which leads perfectly into a final thought for you to consider as you evaluate this transcript against your own models.
This is the real kicker.
Yeah. We just spent a good chunk of time detailing how Summit Hotel Properties achieved margin expansion, raised full-year guidance, and funded aggressive share buybacks.
Right.
But here is the critical context. They are achieving these metrics while the corporate and government travel segments are still only in the recovery phase.
Right. They aren't even back to peak yet.
Exactly. That is the asymmetric upside of this portfolio.
Right. Stanner noted that transient government travel is experiencing a gradual recovery, and corporate negotiated volume is surging, but still stabilizing relative to pre-pandemic baselines.
So, if Summit is actively stripping out 90 basis points of margin expansion and printing 54% flow-throughs in the middle of the demand curve, largely through sheer pricing power.
Right. What happens next?
Exactly. What happens to their bottom line when business, group, and government travel fully return to normalized historical capacity limits?
It's a great question.
If they can hold their current ADRs while baseline occupancy swells, the resulting flow-through could be absolutely explosive.
It forces you to model a scenario where top-line volume growth finally catches up to the structural margin improvements they've made over the last 2 years.
It's a scenario worth running through your own spreadsheets. Make sure you aren't just looking at the lobby. Look at the math underneath it.
Couldn't have said it better.
We'll leave you with that to process.
Yeah.
Keep questioning the assumptions, keep digging into the transcripts, and we will see you on the next deep dive.